Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, May 22nd, and then we'll see how things look for Thursday, May 23rd. A pretty quiet day up until the meeting minutes came out from the FOMC. The market had a negative reaction to that. Apparently, there's some not real consensus about what should be done with the Fed balance sheet. And so there's some disagreement there. When Jerome Powell gave the initial announcement about this, that really helped to prop up the market. And now that they're not really seeing it, that everybody's feeling the same about that, that put a little pressure on the market. However, we went right down to S2, a pivot level that we knew was there. We bounced up off of that and came up well off of the lows going into the close. We are seeing some weakness starting to drift into the market. Our list of extreme positive indicators is getting a little bit shorter, but some of our charts are looking a little more negative. Now, a good solid update could change that. After the close on Wednesday, NVIDIA came out with their earnings report, and they're currently up about 6% the last time I checked, right before I started recording. That's going to change, of course. But we want to keep an eye on NVIDIA in Thursday's session, because it wasn't this last earnings report, but the earnings report before that, I believe, where they had a killer report. The market really gapped up and the stock gapped up. But then NVIDIA spent the rest of the day coming down, 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 down. And by the time we closed, NVIDIA anyway, was pretty much unchanged on the session. We're going to be waiting to see if something like that happens. NVIDIA is the real leader of the stock market right now. So even though I don't necessarily track individual stocks, on Thursday, I will be watching NVIDIA on an intraday basis just to see how things are acting there. Before I get deeper into the video, here is the announcement about the upcoming program that I will be launching. It's a membership-based program, and that will be $97 a month. There are videos on YouTube and Rumble that you can go through and learn more about the program if that's of interest to you. Also, at that time, I'm going to be locking down the daily videos until after the market closes for that day. If you only want to have early access to the videos, it's going to be $19 a month. After the market closes, the video will become free. So it'll be publicly available. The weekly videos that I do, they're still going to stay free. Right when I get them uploaded, I make them publicly available, and they are available to you. And because I see those other videos as supplemental, it's the daily video that's a real foundation of my analysis and commentary of what's going on in the market. If you want to talk about this, here's an email address. Feel free to let me know whether you agree, disagree, leave a comment on Rumble or YouTube. We can try to set up a time to talk if that's of interest to you as well. Now, let's go back and talk about what happened, and then I'll go through some charts. Right at the open, we did have a lower open. It was a pretty sleepy day ahead of the minutes coming out. Prices chopped sideways below the unchanged level, so we were slightly negative. Then after the meeting minutes were released, prices dropped down below the daily pivot at 53.15. We went down to S1 at 53.05. We actually broke below 5,300, down to S2 at 52.88. That's where we found some support right at a pivot point, which you'll see when I get to the chart. Buying took prices back up above 5,300 and then closed slightly above S1. We were down 0.27%, but volume is still below average, even with the big changes that we're seeing. Now, there are some people that have a debate about whether volume is really important or not. I think it's important, but there's a lot of transactions that take place, if you will, that are off of the exchanges. It might be between one company and another company, and there's different ways to do things, and that volume doesn't show up. So there's still things really going on, but we can only go with the information that we have. And when we were going up, we saw above average volume. And when we've gone down, we've been seeing above average volume. So we still have to take that into the overall equation, but it's a classic negative divergence right now, that we were going up with the S&P as volume was going down. To me, that is a concern. Other people say, no, you should just look at price. And that's That's all you need. Well, I agree with that. The price is most important, but right behind it is volume, so we can get an idea of the conviction behind the different moves. We're still positive with our technicals, but we are starting to see some weakness creep in. In yesterday's video, I was pointing out a few things that were starting to look a little weak. And some of this has to do with the way the indicators are calculated, like a moving average. If you have a 10-period moving average that shifts to each next day, and at the beginning of that calculation, the numbers are lower. Well, if price stays about the same and you're ticking day by day by day, as you get further up, it's going to be higher numbers that are included in the calculation. And so it's going to make that moving average start to roll over. And I go through this in my course and explain it in more detail. But in one way, we have to be aware of that. It's just a calculation thing. But in another way, we need to heed that because a lot of people are seeing that. They look for these negative divergences and then they make decisions based on that. So a lot of times it ends up being a self-fulfilling prophecy. And it's still inflation and interest rates. That's what's really the foundation of what's driving the market for right now. We want to keep an eye on the different geopolitical events that are going on. The meetings, it didn't really contain anything too surprising, and it pretty much had said what the Fed had already been saying, but it drew attention to asset valuations and how they're going to be dealing with their balance sheet. And this was taken as a catalyst to say, oh, maybe there's something negative here, let's sell. And then Nvidia is up after earnings came out and they announced a 10-for-1 stock split. My goodness. Stock splits are considered to be very positive for a company. If your stock is going up and up and up, yes, it doubles the amount of stock, or in this case, 10 times the stock. But the price comes down and that's seen as more affordable and more people can get into it. And so when we see stock splits like this, that is taken as good news. We saw that a lot during the whole dot-com boom, where there were people just waiting to buy stocks because they announced a stock split. And you don't hear about that as much. What's dangerous is when you have a reverse split, where let's say for every one share that you have, we're now going to give you, for every 10 shares you have, we'll give you one. That's seen as quite negative. That's trying to prop up a stock's price without really anything happening. Anyway, here's our list for the short term, things that are still extreme positive. You could say overbought. We still have the Stochh RSI, Williams percent R, the stochastics, the slope oscillator, and the RSI based on 9. Notice the CCI, both of those charts have fallen off of this list. We also have a little bit shorter list in the intermediate term with the standard deviations chart. We're coming down, but we're still in that +3 channel. The TTM squeeze is turning a little bit more negative now. The Sean trend meter, the vortex, and then our 10-period moving average study of the highs and lows for the S&P. Long term, we're coming down, but we're still extreme with the 150 and 200 period simple moving averages. And this is the same scenario. Higher for longer with interest rates, because inflation has been stubborn or sticky in coming down. The market is still possibly anticipating that there might be a rate cut in September. We keep pushing that back. And there's a chance that it may get pushed back even more. And as I said before, what was really providing some stimulus for the market to go back up was that the Fed is decreasing their QT, quantitative tapering. Apparently there was some disagreement over that at the last meeting. And the dollar was up and interest rates were up, which also pressured stocks. We closed at 4.43% for the 10-year yield, where we had been at 4.41% yesterday. We're still inverted with the yield curves. Sentiment did tick down, but it's still positive at 59, where it had been at 63. We're still positive with our trend. The ADX is above the moving average and the green line is still on top. And I should have changed the bias to negative. So it was a little more than 0.25% down, but momentum still continues to be positive for the time being. We finally got some economic reports this week, but then they weren't all that big of a deal. The weekly MBA mortgage applications index, and I do have a chart of that. We'd like to keep an eye on this. It just gives us an idea what's going on in the housing market. It was up 1.9%. Last week, it was up 0.5%. And I don't have a chart of this. Existing home sales were at 4.14 million, a little bit less than the 4.2 million they had expected. And we saw 4.22 million last time. So here's a chart of the mortgage applications where it did come up from the previous week, and we are positive. And possibly with interest rates coming down just a little bit, but housing prices are still just really continuing to go up for the time being. Here's some Isabel Net block charts. This is taking inflation adjusted market capitalization and then doing a ratio with GDP. This is called the Buffett indicator. And I used to show this. There's a website out there that I have in the description called currentmarketvaluation.com. And somebody was pretty good about updating those charts once a week. I checked over the weekend, and nobody's updated any of those charts since the end of March, I believe it is. And it's like, okay, these charts are useless to us. And it gives us a bigger picture look. If somebody would update those charts, one of those indicators is called the Buffett indicator, because apparently at some point Warren Buffett said, oh, this is a really good indicator. And so because he's so famous, they kind of named it after him, where we see the S&P 500 stock price, this is going up. And then here we have the Buffett indicator as well. And it's just showing where we're at 2.61 right now with the S&P, and we're at 2.04. So we're kind of getting up there. You can see other times where this ratio was actually quite a bit lower, and we're getting to a really high reading at the present time. Then 24 new highs so far for 2024. And so that's putting us on pace, at least anyway, we'll get 61.7. I'd like to get a 0.7% of a new high. That's kind of interesting how that works. But we're, every day that we incrementally or by a large amount go higher, then that just sets a new all-time high. And then buybacks, it did drop off, but it's still very high. So it's off of the historic highs. And these are corporates that are buying back their own stock. This is something that we keep a real watch on. And I'm trying to do some more research in this to see if we can take this data and actually use it in a more analytical way. Edward Yardeni wrote a book about this. And so I've been rereading that book lately to see if there's anything that can help us. And then the probability of a U.S. recession in the next year, it's right now down at 30%, according to the market, where Goldman Sachs has put it down to a 15% likelihood. And this could always flare back up. At some point in the future, the U.S. is going to go into a recession. We don't know if it's going to be in this cycle or if it's going to be delayed, if there's going to be some kind of a black swan event that comes in and really has an impact on the economy. That's going to change everything. I mean, the economy was humming along pretty good right up until the COVID lockdowns. And that just threw everything off to the side. Is there going to be something like that happens again? And then here, sector fund flows, you still see most of the money going into tech. Now, yesterday I showed a chart that showed that money was coming out of tech. So we're seeing a little bit of a dip down here. But this is the darling sector of the market right now, where the other sectors, yeah, they see some money going in. It's hard to tell with these lines. I think this is industrials and kind of this brown line. Which one is that one? Telecom. Yeah, that's also another stronger area. But it's tech that really sees a lot of love. At least it has over the last few years. Well, 2022, you can kind of throw that out. Then our leading earnings model points to a healthy earnings per share growth backdrop. So this is Morgan Stanley, where this is the actual leading 12 months. I guess that's what LTM is. Sometimes it could mean the last 12 months. They use different acronyms. I wish they would standardize on these. But the blue line is going up, and then what they are suggesting at Morgan Stanley is that the earnings growth is going to go up as well. And that's positive for stocks. Financial conditions. We are coming down. We're being a little bit looser. There's a little more liquidity in the market now. Part of that may be to do with the Fed decreasing their quantitative tapering, and a lot of that money goes into the market. That money is used to buy things, and that props prices higher. Then here's sectors. We still have the total right here, and I have to move this bar that you can't see. The biggest inflows are going into ETFs. Of course, that's what I focus on, but I mainly focus on the SPY. And then the different sectors that are seeing inflows like communication, tech, kind of going back and forth with real estate. Where we're seeing really taken out is consumer discretionary. And that's one of the more growth areas that we would like to see doing better, but it's just not. And we're seeing a lot of money coming out of industrials currently. Okay, then now this is next 12 months PE. This is looking out. You could say forward PE ratio. Anyway, Goldman Sachs has us looking out at 20.9. When we get above the 20 level with the PE ratio, that's when it's considered to be expensive. It was getting higher than that, and I show charts about this in the weekly video where I look at the forward PE ratio, and I also compare it to the historical or trailing 12-month PE ratio. I didn't really find anything interesting on Twitter. A lot of people, these self-proclaimed geniuses have all their wisdom that they want to share, but I didn't really find anything all that insightful at this time. Of course, I've been working on the program and redoing my courses and things like that, so I haven't had a lot of time or really interest to do things like that. Here's the intraday chart where we did have a lower open. We were below the unchanged level. We came down to the daily pivot a couple of times. We quickly went back up. Then here is when the meeting minutes came out, and that's when we saw prices go down below S1, down to S2, bounce up off of that. We ended up closing back above S1. That's why I love these pivot points so much, because they're on the chart before the market even opens. I post these on the YouTube community tab every day, and these are levels that beforehand that you can be watching just to get an idea of what's happening in the market. Here's our intraday chart showing the dip and then the move back up. We are up a bit in the after hours session, and the S&P futures anyway are riding more of the NVIDIA announcement. We're still looking okay here with our intraday growth of value. The blue line is still above the red line, and it was up where value was down, at least intraday. We're also seeing a little bit of an improvement here with the growth to value ratio for the S&P. So not much of an improvement, but a slight improvement. Where growth was down, but it was down less for the large caps, down more with the mid caps, and down more with the small caps. So we're seeing red across the board here. And the growth to value ratios, they're just not, yeah, we went up, but they're just not showing an awful lot of strength right now. When we look at small cap growth to value, mid cap growth to value, and S&P growth to value, where here it actually turned down on our end of day chart. Here's the growth to value ETFs that we look at. This is looking okay. We're finally starting to come up out of the rainbow. And the reason why I look at a number of different things is this is an ETF and it has its own way of calculating. If I go back to these other indexes that we look at, they're calculated slightly different. So we want to see confirmation across multiple indexes. Discretionary to staples going down, but still above its 200-day moving average with this ratio. Large cap growth was down, but still maintaining price at near all-time highs. The Wilshire down 1/3%, also near all-time highs. We're still positive with our trend, even though the green line is coming down. The ADX is above its moving average. It's flattening out a bit right now. But for right now, we're above 20. We're above the moving average, and the green line is on top. So it's a strengthening positive trend. Short term rolling over a little bit too, but still above the moving average, also a strengthening positive trend. We continue to go down with volume, and that is a bit of a concern. We're getting a very low reading when we look at the Ulcer Index. We did get the latest reading from Investors Intelligence. We're at 3.45. That's up from, I believe it was 3.1 last time. So we're starting to get a little extreme, but we could still go higher than where we're at right now. We ticked up with the VIX on the line chart as well as the bar chart as prices ended up declining. And we're seeing a pickup here with the VIX of the VIX. So the volatility of the VIX is starting to go back up, where we were well off the highs. This really spiked up when prices were going down, and we closed down underneath the moving averages. The momentum for the VIX continues to be down. Want to keep an eye on the SKU index. I brought this out in the What to Watch video over the weekend. We're getting kind of close to this red area. Now, we're not there yet, but if we go up into this red area, that means the market is expecting some kind of a big move. We don't know if that's an up move or a down move, and that's why I put all these arrows on here, because it can mean either or just a continuation of what was already happening. Now, we may not get up into this red area, but if we do, then spike and start to come down, that might be when something big is happening, either up or down. And this is a day late now. These weren't updated, but at least yesterday we saw the equity put call ratio go up, and we're starting to turn back up with the 5-period, but this is a day late now. We're going back up slightly with the volatility risk premium, but we're still underneath this band. So it's showing that there's not a lot of VRP in the market right now. We declined a little bit with this fear gauge, and we ticked up just barely. It's really hard to see, but we did tick up a little bit with this other fear gauge that we follow. So we're rolling over a bit with price and volume when we look at the advanced decline line. We're starting to flatten out with our 5-period simple moving average of the new highs minus the new lows. And we saw a little bit of an expansion in new lows, but mainly this is getting weaker because we're seeing a contraction of the new highs. We're rolling over, but still positive with the advanced decline ratio. And this is part of a teeny tiny bit of weakness that could be coming in. Accumulation distribution did tick down, but is above the moving average. Chicken money flow is pretty much flat, but still positive. The chicken oscillator kind of going sideways, but still positive. We came down with the cumulative NYSE advanced decline line. We also came down slightly with the regular advanced decline line. We also declined with this other NYSE advanced decline line that we follow. We came down with the NYSE common stock based on price and volume. But you can see here, volume was down, or excuse me, price was down a little bit more than volume. Not sure what to read into that. Could be taken as positive. And when we look at the cumulative advanced decline line for the S&P, we rolled over based on price and kind of rolled over based on volume. The advanced decline line studies, we saw declines here, but all of the major indexes that we follow are still above their rising moving averages. Even the small caps moving average is going up slightly. In the short term, nothing really that we're seeing here. If we go up, we have overhead resistance. If we come down, we might have some support. We're still above the 50-day moving average. We continue to be below average with volume. The Stochk RSI is extreme positive, and the Williams percent R is also extreme positive, and the CCI charts are not in here. But the stochastics were still extreme in the short, intermediate, and long term. Looking at our double and triple exponential moving average based on 20 periods, we're coming down in between both of these lines for the time being. And we're rolling over with our 20, 50, and 200 period exponential moving average of the S&P itself. That's showing a little bit of weakness there. The force index did decline, but it's still positive. We want to keep an eye on the 20-period moving averages in case we see more of a pullback. Standard deviations were coming down into the lower end of the +3 channel, but we're still in that channel. It would no longer be extreme if we would come down into the +2 channel. Balance of power, which had been extreme positive, just barely came back down below the black line. The go, no go remains positive with the dark blue bars. We're still looking good with the highest high value. We're pretty much pegged along the blue line, which is the highest high value. TTM squeeze, it's going from a lighter shade of blue now to a darker shade of blue, and that's slightly turning negative. You can see what happened other times. Doesn't necessarily mean price is going to follow that. It just means that this indicator is starting to show some weakness, or it's running out of a bit of steam. Here's a longer term look where we're going from the light blue to the dark blue right now. Looking at our double and triple exponential moving averages based on 50 periods, we're still above both. And if we can stay above this, that will give the red line a chance to cross above the blue line to show that the momentum is stronger. The CMB composite finally came down after spending about a week being extreme positive. It's now just barely dropping below the line again. Want to keep an eye on the 50-period moving averages just to see how they're behaving. Right now, we're still kind of far away from them. The ease of movement actually, well, it flattened out, but it's still looking a little bit more positive. The Erin indicator is now going flat. It is still positive. We're dropping just barely negative with the S&P McClellan oscillator. We've dropped, it's minus 0.76 right now. So it has gone negative. So we're seeing a little bit of flattening out with the summation index based on price, a little bit of turning down based on volume. This is some of the weakness that I'm alluding to here. We also dropped below zero with the NYSE McClellan oscillator. It's hard to see here, but we're just starting to tick over a little bit with the summation index for the NYSE based on price and volume. Swenlin trading oscillator. This has been one of the warning signs that we've been keeping an eye on. We're still positive since we're above zero, but we have been declining. And this was starting to go down as the S&P was still going up to sideways. So that's another area of potential weakness that we could be seeing. But our momentum oscillators are still positive. The PMO, also based on price and volume. We're seeing a little bit of a pullback with the PMOs that are rising. We're starting to turn down with the buy signals, and we're flattening out with the PMOs above zero. We still remain neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're still looking okay, but starting to flatten out a little bit with the slope oscillator. The MACD is continuing to be positive. All of our oscillators in the short, intermediate, and long term continue to be positive, with the slope oscillator kind of giving us the most fits right now. That's why I have a breakout chart of that oscillator. Still above all the moving averages in our moving average tree. We came down just a little bit with the bullish percent index, turning down slightly with the NYSE bullish percent index, and down slightly as well with the NASDAQ 100 bullish percent index. The money flow, after just barely getting extreme positive, has now pulled back, but it is still positive. The ultimate oscillator is still positive, and the vortex is still extreme positive. It's kind of flattening out above this red line. We're not extreme with the RSI 14. We turned down just slightly, but we're still extreme with the RSI 9, even though we are dropping. On balance volume, did see a decline, but we're still above an advancing moving average. The stocks above their 20-period moving averages is declining, but still above 50. And we're dropping down below this 70 level now. We'll have to see, is the move up over for the time being? Or are we going to be able to turn and go back up with this if price is able to go back up as well? We kind of got the signal from this for the time being, and now we just have to see how it plays out after that. Because there were times when we did see this drop down below 70 only to have it come back up. Stocks above their 50-period moving average is declining, but still above 50. We're declining with the 100 and declining with the 200 moving average study. The copy curve rolling over, but still positive. The Sean trend meter is declining, but still in the second layer of extreme positive. The Pring bottom fisher is still generating a buy signal and has been since the last part of April. Mass index, not sure what to make of this. I'm just going to keep this chart on here for the next few days. If nothing really significant happens by the end of this week, I'll watch it, but I won't talk about it. We're still looking okay on the Heiken Ashi, looking like a little bit of a doji right now with this candle. The Kegi, though, is still positive. The Renko continues to be positive, and the three-line break is still positive. In the long term, rolling over with our 150 and 200, but still above these red lines, which means we're extreme positive. We're still positive with the Keller market model. We didn't see enough of a decline for anything here to change, and we're still negative in the intermediate to long term with bonds based on price. We're also in a short-term downtrend with the dollar, even though it was up. And we did have an update of the decision point scorecard. We're positive in the short and intermediate term, where we're mixed in the long term. Here are the alerts, where it started off okay with NASDAQ setting a new all-time high. Volatility index set a 4-year low. That's the VIX. We saw discretionary have a MACD crossover negative. Then the NASDAQ set a 4-year high. Then we saw some sectors. Industrials and materials show some weakness. Canada, hey, good for you, Canada, set a new all-time high. And then near the close, the NASDAQ was able to get back above 16.8. So looking at the sectors, tech was in first place. Healthcare, that's another area, defensive area that we're keeping an eye on. Industrials and communication were positive. All of the other sectors were negative. Staples, another area that we're watching. We're also kind of disappointed with what's happening in discretionary. And we saw some profit taking finally in utilities. We'll see if that can show some more strength, as well as energy. So the equal weight, if when we look here, the mega caps held up better than the rest of the market. So this ratio shot up a bit. The Dow did see a decline, but it's still above this pivot point here. And this is just not looking good for the transports. We're just really continuing to go down when we look at the ratio between the transports and the S&P. We are still neutral with the diamonds when looking at the Elder's Impulse system. The NASDAQ was down 0.18%, a very small decrease there. And we were almost unchanged, but down 0.05% with the NASDAQ 100. We continue to be neutral with the QQQs. The momentum for the NASDAQ 100 is still positive. The Qs are still above these moving averages, so we're seeing more of a crossover. That's the 20 period crossing above the 50, which is turning things slightly more positive. Small caps, yeah, they got to the high end of their range. So what do they have to do now? Go down, and they did. But we're still neutral with the Elder's Impulse system for the small caps. We're dropping, but still above 50 with the Russell 2000 small caps. When we look at the RSI, we're still above the 50-day moving average. And the momentum is rolling over, but it's still positive for the small caps here. Mid caps dropped below this pivot point. So it had been holding up above this. Now we fell down below it. We're still above the 50-day moving average, however. And the mid caps remain neutral with the Elder's Impulse system. Apple was down 0.75%, still in a downtrend, but if it can stay above its 200-day moving average, eventually the 50 will come back and cross. Tesla was down almost 3.5%, still dealing with its 50-day moving average and below its 200-day moving average and in a downtrend. Here's NVIDIA. We'll see what happens. It ended up closing down almost 0.5%, but it's up, as I checked, 6%. Now, that's going to change a whole lot between now and the open, but we'll have to see how it acts during the day. Is it going to pull the rest of the market up with it? Is it going to be able to hang on to any gains itself? Microsoft was up 0.34% and is still looking pretty solid there. Meta was up 0.58%, but still below its 50-day moving average. I guess it was up 0.68%. Amazon was virtually unchanged and just a little bit above its 50-day moving average. Google was down and still above its 50-day moving average. Netflix was down 1.5%, but still above its 50-day moving average. And the FANG index, after setting an all-time high, did pull back 0.66%. The financial sector was also down over 0.5%, but still above its 50-day moving average. We're seeing this ratio going back down a little bit when we look at staples to tech. We want this to go down if we're going to be more positive with tech. The dollar was up. We're getting back up into the high 104 range now. That can be pressuring stocks. Looking at the S&P versus world index, the short-term relationship is pretty strong based on 10 periods. Seeing a little bit of a tick up here when we look at the 50-period correlation. The staples sector was down, but still has been in a longer-term uptrend and is still well above its 50-day moving average. Utilities did pull back, but have just been going to the moon lately. Healthcare and actually ended up closing a little bit higher, so that's looking positive by itself. And then energy, it's finally dropping below its 50-day moving average, where it had been hanging out around that level. When we look at the total U.S. stock ETF, we were down 0.34%, but still coming off of an all-time high. We were up with the 10-year based on the yield. We're coming back up to the 50-day moving average. We were down with the 10-year based on price. We're still looking good here when we look at the Qs to 3 to 7 year bonds. This ratio continues to go up, so that's positive. The tech sector also going up when compared to 3 to 7 year bonds. The other ratios that I've been following, they weren't up. I'm only showing them when they're going up right now. And then looking at our growth of value, seeing a little bit of an improvement with Qs to the S&P, still seeing weakness with discretionary to the S&P. And large cap growth is showing a little bit of strength when compared to large cap value. So we're looking a little better with the large caps, coming back down to a declining moving average with the mid caps and showing a little bit of strength with the small caps. We're still looking good here with our 10-day average of the S&P 500 highs minus the lows. We are extreme positive. We came down a little bit, but we're still a positive with our advanced decline ratio based on price and volume. And the S&P to utilities ratio ticked up just a little bit, but we want to see more conviction going up for us to turn more positive here. And we also want to see this ratio continue to go back down when we look at staples to the S&P 500. So what's our outlook for Thursday? NVIDIA, as I said, was up 6% after hours once their earnings reports came out. And then I saw after that where they made a 10-to-1 stock split announcement, which is also quite often taken as quite positive. We're still positive. We still have a lot of extreme positive readings, and we're just wondering, is weakness starting to come in? We will get the weekly jobless claims. That's kind of the biggest thing on Thursday. We're going to get the S&P Global U.S. Manufacturing and Services PMI, the preliminary reading. They're not as influential as you might think. We're going to get new home sales, and then we want to keep an eye on all the geopolitical events. You can kind of see Yemen there at the bottom. And then on Friday, we're going to have durable goods and consumer sentiment. And here is the block for what happens in Thursday's session. Seasonality, we're neutral to positive across the board. Everything is up 57.1% of the time when we go back 21 years. For the Dow, S&P, and NASDAQ, we're still in the week after options expiration, which usually is up more than down. We're going to have a good couple of days to change that, possibly. Looking at the Stock Traders Almanac, we do see some weakness on this day with the green dashed line before we finally get beyond this weaker period and then see a little bit more strength going into the latter part of May. Also, the market will be closed on Monday for Memorial Day, so break out the barbecues. Thursday is a positive day, typically based on what happened in 2023. We're also following this other Stock Traders Almanac chart where the green line, it's a few days out of date now, where this shows what we've been doing. And then they took the sitting president in blue, but they threw out 2020 to make it match up with this black line here. So we're still in, once we get through this part in May, things tend to look a little bit better going forward. We're still coming into the latter part of the negative time, according to Tom Bowley's research. So our warning signs, the mass index, not sure. It's becoming more irrelevant as each day passes. So we'll just keep an eye on it for now. We're also watching the staples and utilities, and this is just a warning sign. And we're also watching energy as well as healthcare. Energy right now, anyway, has been more of a defensive play where healthcare, utilities, and staples are usually, and then they break these things down. So it's not always quite black and white, but as a general rule, staples, utilities, and healthcare are considered to be defensive. And then growth to value ratios, not showing a lot of leadership right now, nor is the discretionary to staples ratios. And are we starting to see some weakness coming into the market? Again, NVIDIA could light the market on fire, really give the tech sector and the rest of the market a real upward thrust. If we can make something like that happen going into the close, that's going to change a lot of the technical picture. Are we going to see some selling into strength? Are we going to see these defensive areas continue to outperform as they have been lately? And the positive signs, I took a few things off of here, but we have a pretty long list of indicators. Even though they're showing some weakness, we continue to be quite positive for the time being. And our conclusion, we're still extreme positive. Are we starting to see some weakness coming in? That's what we're seeing in the short term. A little bit of that we're seeing in the intermediate term, where we're still positive in the long term. So just looking like a pullback for right now, but we'll be watching to see if there's some real conviction behind any selling if that ends up coming into the market. Thank you. I really hope you found this helpful. I want to welcome all the new people that have been watching these videos. I really appreciate that. I really hope you find these videos helpful. I hope you have a really good day, and I will talk to you in the next video.